Hey guys, welcome back to the channel. Again, I want to thank everyone for all of the support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today I want to dive back into the portfolio to go through what a covered call is in a little bit more detail. On my prior video, there were quite a few questions on exactly what is a covered call, what do you need, what sort of collateral do you need for a covered call, and how is a covered call that different from a limit order? And why do a covered call instead of simply selling off a stock as you would normally, again, with typically a limit order placed on a stock? I'll kind of go through all of that, but essentially you are getting paid to put in your limit sell order, where normally you would just simply put an order in without getting an extra rate of return. So we'll kind of go through that. Let's first focus on the portfolio here. As you can see here, not a good day of trading. Last trading day down 1.77% of the overall portfolio, 26.2804. A little bit extra in after hours trading there, 68.20.05%. A lot of this had to do with renewed focus on tariffs, a potential trade war with China, 100 billion more in tariffs that are potentially going to be enacted by the current U.S. administration. Because of that, there was definitely a sell-off during the day. There was one stock that I did jump into. I recently put out a dividend capture review video about that stock. Let's go to the bottom to review that trade. Decided to jump out of that stock because I thought the stock market would kind of sell off there with that news on Friday. You can see here General Mills, it did dip down here. The whole idea was to jump into the stock for a dividend capture swing trade. I think this is a very good stock moving forward. This is a blue chip stock, and as you can see here, it may be on discount here. It's down 18.67% over the past 1 year. Over the past 5 years, you can really see this big pullback here just over the last few months or so. On the bottom here, let's go through the trades here for complete transparency. You can see the market buy here, 45, 40, 50 shares. The idea was to hold this through the ex-dividend date, get the ex-dividend payment qualified, get that dividend payment, and then sell the stock off later, probably in a few months, maybe even holding it longer term for a nice swing trade. But again, because of the talk in the stock market with the tariffs, wanted to sell off, went ahead and did that. Was going to buy back, but I missed the opportunity here. You can see in after hours trading here, it did come back up to 45.79. So a little bit of a missed opportunity, but still a positive swing trade on the bottom. As you can see there, 22.70 up to 22.8750. So essentially $17.50 swing trade. And if this stock does come down a bit on Monday, I probably will jump into the stock. But again, this is a good stock, I think, moving forward as a buy and hold, but also is very minimal to dividend capture swing trading as well. So now let's jump back into the portfolio with regards to options. So let's first focus on what do you need to do in options, do a covered call, selling an option. So let's go take a look at a stock that I do not have 100 shares in, and you'll kind of see what the requirements are here. So ABBV here, this is a very good stock. You can really see here it has been pulling back here a bit. So there may be a buying opportunity here on discount, but it still is up 42.57% over the past 1 year. So let's say, for example, we had this in our portfolio. You can see here I only have 31 shares, but let's say we wanted to do a normal sell on this particular stock. So it's currently at 89.78. Let's say I wanted to sell this stock off at $95. Well, I simply would push trade, sell, then I would go up to order types, put in a limit sell. So this would be the minimum that I would receive for the stock. So let's say I want to sell the stock at stock off for $95. I would simply put that in. I'd simply put in never expire, so that way the trade will always be there until it's sold off for $95. If the stock does not get to $95, I'll never sell the stock off. Again, I have 31 shares here. I'll just do one share, for example. Click on OK, and then I simply would swipe up and I would put that order in place. You can see there, this is good till canceled. So if the stock does get up to $95, I will sell the stock and I will get the proceeds of that particular trade, $95. But let's say now, for example, let's sell off the stock as an option. So basically, I'll get paid to do that exact same order. So now I'll push trade. I'll do an options trade. And you can see up on the top there, I'll do a sell, a call. So this is what is called a covered call. We'll go into what is required for that. And then I'll go ahead and pick a date. You can see there are a number of different dates here. That last order I put in never expires. So to kind of replicate that, you could go over to, for example, the latest date here, I think it may be 2018, or actually January 17, 2020. So let's go up to $95. Again, I want to sell the stock off for $95. You can see now if I do that particular trade, for every 100 shares that I sell off, I'll get $1,090. Again, every contract is 100 shares. And you can see I'll get $10.90 for every stock I sell off. So just like that last order, it's the same exact transaction, but now I'm getting paid $10.90 on top of the share price that I'll receive, that $95. So I'll essentially get $95 plus $10.90. Now let's say I want to go ahead and try to execute this trade. You can see there it's showing that I do not have enough shares. So to do this type of strategy, you need to have this stock in your portfolio. So if I were to do this, I would have to have 100 shares of ABBV here, AVI, before I could carry out that trade. So I hope that makes sense. So let's take a look at a stock that I do have 100 shares in, and that would be Ford here. So let's go ahead and do that same order set in Ford here. So let's say, for example, I want to sell this stock off at $11.50. So I would pick trade, sell. Again, I want to specify the exact price I want. So I do a limit order, $11.50. Never expires. I do a 100 shares, and you can see the proceeds I would get would be $1,150. And since this is never going to expire, this would simply be pending until the stock got up to $11.50. If it did not get up to that price, it simply would not execute, and it would simply be sitting in the portfolio. Again, to do this, I'd be selling off 100 shares at $11.50 per share. I would get $1,150 as proceeds from that sale. Now let's say I want to do that same transaction, but I want to get paid to do it. So I would do a covered call again. I would do a sell, a call. And then again, let's go over to a date that's a little bit farther off again, kind of like a limit sale that never expires. They don't have necessarily $11.50. Let's pick the closest one here, which would be $11.87. So for this example, this will be the $11.50. We'll put one contract in, which is, again, 100 shares, just like before. You'll see now that I get a credit of $99 just for putting that order in place. And I will also get the proceeds of selling off that stock. And as you can see on the bottom there, I'm agreeing to sell 100 shares of Ford at $11.87. Again, for the example from prior, you could put $11.50 in there. It would not change any of the transaction here. And I would get essentially paid $100 to do the same exact trade. So if this trade would execute, I would get the proceeds of that trade. I would be required to sell off 100 shares, again, at $11.50. Here, they didn't have that, so I put $11.87, but I would get paid to do that. So the exact same trade, by doing a covered call, I get paid to do my trade. By doing a limit order, I simply would put that order in, and I would get no additional payment for that particular trade. So I hope that makes sense. It's just a different way of doing this type of strategy. And really, for the type of strategy I'm doing, there's really no risk in this other than your general stock market risk. For example, Ford here could go down to zero at any time. There's no guarantee that a stock will retain its value. But whether I do that as a limit order sell-off or if I do an options sell-off, a covered call, so again, a trade, sell, limit order here would be one way of doing it. Or I could simply do trade, options, do a covered call by doing a sell and call for the exact same price, for the exact same number of shares. And in that fashion, I get paid for doing the exact same trade. So that is what is called a covered call. You need 100 shares to do that. You have to have that in your account. You can't do what it's called like a naked trade, where you essentially do this trade without having those shares in your portfolio. But if you were having to sell the stock off in the future, you'd have to buy those from the open market. And at that point, it would be more than what you were selling off the stock for. So it's a little bit more risk doing it that way. But if you have stocks in your portfolio that you're holding longer term, you can even make money off this if you don't think that trade is ever going to execute. So again, let's say we do a trade, options, we do a sell call, and let's put in something that's very recent here, next week, April 13th. Let's say I put in $14. There's really no chance that this stock will get up to $14. I'll make essentially $1 for this particular trade, 1 cent per share. Not a lot of money, but it's simply free money here. I don't think this is ever going to happen. And if it did happen, I would be very enthusiastic about that because I would be selling off stocks that I bought for $10 to $10.50 for $14. So really, there's no risk from my point of view in the way that I'm doing these stocks. I'm doing these stocks in quality blue chip companies that are buy and hold stocks that are making a return on investment just by putting in those limit sell orders as options, again, as a covered call option. So I don't do limit sell orders by themselves. I would do a call option. I would sell off the option. I would do a covered call, doing essentially the same thing, but you get paid for that. The one thing I want to point out is that you're obligated to sell that stock off. So if the stock did go up to your strike price, whatever price you put in, you're obligated to sell off. But again, if you put it in as a limit sell order that was pending, you'd simply sell off as well. So either way, you'd be doing the exact same transaction, but if you do it as an options trade, you get that extra benefit. And the other good part about this is that if the stock does not get up to your price, if you don't sell it off by the expiration date of your option, you simply keep that premium, and then you can put in another order for that same exact 100 shares and simply repeat that process every week or every month or whatever date you're putting on that expiration date on the options contract. You can simply do this over and over and over and generate income on stocks that you're already holding longer term in your portfolio. You still get the dividends on those stocks, plus you get this added premium of selling off covered calls. So I hope that kind of helps solidify exactly what is going on here, why it's so beneficial in doing a options call, a covered call. Again, you're selling off a call to another investor. You are agreeing to sell a stock at a particular price to another investor, but you get a premium rather than simply selling to the market at a particular price with a limit order. And you can do this as many times as you want, and if you don't sell off the stock, you still keep that premium, you still get the dividends, and you can do another contract with another expiration date in the future. So that is what I'm going to be doing with my buy and hold stocks. I'll be posting some videos on this as well. I've sort of understood options trading by going through some very simple options trades here, and that's why I'm going through the portfolio and really trying to update you guys on what I'm doing. Is I've learned quite a bit about options trading just by doing some of these option trades on Robinhood here. Again, commission free, just very low value volume trades, low value trades, just to learn exactly what I'm doing on options before I jump into big trades with lots of capital and lots of shares. So again, let me know if you guys have any questions about anything that I discussed in this video. So if there is anything that you guys want to know on this video, please let me know. I know in that last video there were quite a few comments wondering exactly what options are. They're very complex. I definitely think they are much more complex than simply buying and selling individual securities, individual stocks, but they are also very powerful to generate passive income as well as provide insurance on some particular trades as well, which I'll be talking about in prior videos as well. So not to make the video too long, I'll kind of end it here. Again, if you guys have questions, please let me know in the comment threads down below. I'll do my best to get back to you guys as quickly as I can. And kind of with that, I'll end the video, and we'll see you guys next time.